Hi, it's Greg Schnell, and I'm here with your Daily 5. So I want to focus on the S&P 500 for a little bit here because there's a couple of important things going on that I want to make sure everybody's aware of. One of the big things, obviously, is that we've been focused at this 4,100 level for a while. We've spent almost 3 weeks here trying to get through it. The same thing happened in February when we rolled down. And in November, we kind of got up to the same level. And back in July, we actually made it above the level for 1 week and then basically gave it all back. So this 4,100 level has been a real difficult level for the market. But it's also difficult in a couple of meaningful ways. One is, notice where the PPO is here. It's right at zero. And there's a real important reason to think about this. So I want to talk about the broader scope of a bear market. So we've come down and somehow, I've got all kinds of things that are spiking to new either COVID lows or 2009 lows. You're seeing shipping rates come down for containers across the ocean. Trucking rates for stuff moving across the country are dropping. You're seeing lumber having pulled all the way back to kind of typical ranges before. But you're seeing big reversals in a lot of different areas of the market. And it just seems to me like we've been living on this hope that we're going to get through it. So I want to take a minute and just explain what could happen if things don't go well. And so it's the third week of our stall here, and I think it's pretty important. So this is a picture of the S&P 500 going back 25 years. And what I've shown here is that what you see is in a big bear market, the middle Fibonacci levels of 38.2 and 61.8, there we go, levels kind of mark the middle of what happened in the area. And then the bottom, if you pulled this all the way down, so right to the bottom low from the prior high, you'll see that most of the price action occurred right in the middle, and the bounces got up to the top, then came down. This one moved a long way down, but using the other bottom, we got up to the 50%, and then we started to fall away. So what happened in 07, 08 was we did the same thing. We fell down to the 38.2, then we bounced up to the 61.8, and then we bounced down, then we bounced up to the 50, and then we started to fall apart. Now in this case, it got really bad. So this was more extreme. This was almost a double the move down. We were at 1,500. We were supposed to get to about 1,100, and we ended up at 67, call it 670. So it was a pretty significant move. But if we just take that same idea and just say, let's put the center of the fibs at the price action we've had over the last while. If it doesn't work out and we roll back down, where are we going to? And this number says 2975. So just real rough, let's call it 3,000, but we were up nicely at 4,800. So a pullback to 3,000 would be meaningful. And if you do the same thing on the Nasdaq, you end up closer to the COVID lows. So I'm not trying to be doom and gloom, but the one thing I want to point out is in 2001, when the stock market rallied from below zero and got up to zero and stalled, that was a pretty important place on the chart and then fell down. And then in 2007, 2008, we got up there and we stalled right around zero, and then we fell apart again. What we've done now is we got right up around zero, and we're at 0.5. And whether we roll down here or keep going sideways for a bit, it's a really important question. But the main step back perspective I want you to have is understanding that if we do just roll down into a big bear market from here, these two parts of the slide are the most significant parts of the slide. So I'm not predicting it. I'm just saying the charts are all set up for it. We have a lot of data that's very, very weak. And if it doesn't work out well, at least be aware of the downside potential. So again, whether it's 3,000 or 2,800 or 3,200, that's not really the main point. The main point here is we're up around 4,100. We've been having a lot of trouble at this level over and over and over again. And maybe the market's more resilient and we're somehow magically going to get the Fed to thread the needle and all that kind of stuff. But the big thing here is to try not to get caught. So is this the week to worry about it? Well, when we look at the S&P 500 daily, what I've done is I've marked some very low volume periods in here. And you can see that this was the lowest volume going all the way back to the beginning of the year, and then only December and Thanksgiving created lower volumes. And then you go back to August, to June, and to March, and you'll notice that we had very low volumes at that time, roughly just under 2 billion shares traded, and that was kind of where we marked the top. So in March, we ended up having very low volume and rolled over. In June, very low volume and rolled over, and in August, very low volume and rolled over. So here we sit, we're getting down to, again, the lowest volumes of the year of 2023, but more importantly, also similar levels where the market was so uninterested that we couldn't hold the rallies we were in, and the market started to fall away. So this is an important time for us to be aware, and the other main thing that I notice is this big trend line on my PPO is starting to decline. So those two charts, 1A and 2, kind of lay out the background of why I'm a little bit more worried here and why the timing I think is critical. So you're sitting right here, low volume, and you're right at resistance. So if we do the same thing on the Nasdaq, and I could bring up all kinds of charts, but what I want to show here is when the Nasdaq was outperforming, we were in a bull market, and that's kind of when we hit the December highs, when we started to underperform. We've got a sloping downtrend on the Nasdaq that went on for almost a year, right to 2023, and then we had a ramp up, and now we're starting to break that little trend line. Now, I could draw a little trend line in here and all that kind of stuff. I'm just saying, it's not for sure that this is the problem area, but we also see the same thing on the Nasdaq. Really big declining volume lately, and last week was a short week with Good Friday. But the other thing to remember is on a daily basis, we're slipping a little bit. So again, getting right up near that zero level, if we were to roll over here, this would be an important inflection point. The only reason for me presenting it is so that people understand kind of the imbalance or what the market's fighting through right here, right now, and why it's so important that we go higher. And then if you had to pick two winning stocks or a few winning stocks to kind of ride this storm out, where would you go? Well, Merck as a pharmaceutical has been pushing up lately here as the market's been stalling out, and it's trying to get through prior highs. So maybe something like a Merck, and I could draw a downsloping trend line across its relative strength compared to the S&P 500, and it's trying to break out to the upside. And then if I had to pick one more, maybe something like a Raytheon, which is sitting right at horizontal resistance up near its 52-week highs, with the exception of the one spike in here. But I think we could all call $100 relative resistance. And if this could start to get some momentum to the upside, I think it would be a positive chart. Now, again, I think if the overall market starts to pull back, you'll notice that when the market made its lows in September, October, this chart made its lows as well. So these are not recession-proof charts. They're just really nice setups right now. If the market does make a stand and is able to run on, this would be a better place to look. Okay, so again, I always try to show both sides of the coin, what's bullish, what's bearish. The one thing I'm starting to notice is, oil trying to break out, and maybe if oil could break out, that would be a macro picture that would be much more positive. So if you like the kind of work we do, more than welcome to come over and try things for just $7 for the first month at ospreystrategic.org. I've got my own strength indexes that I monitor, and this one was recently at 93. It's dropped in the last 10 days to 66. So we're definitely losing some upside momentum. But again, the idea is to try and keep your capital safe, so when this bear market's over, we make some real money, and we try to just at least not have a bullish or bearish bias, but an understanding of what's going on with price action. And again, when my strength indexes start to fail, that makes me much more cautious. So with that, thank you for taking the time to join me. As always, trade safe, plan your trades. Just make sure you understand the big macro picture here, and if we start to slip, this wouldn't be a good place to just say, I'm going to let my trades run. Anyway, thanks everybody. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.